I'd like to welcome everybody out to the November AgriSompo marketing meeting. I'm excited about this meeting today because I've got a guest with me that I've worked for a good while, maybe 20, 25 years in the grain business. And we're joined today by Dan McNeil. And I believe, Dan, you're in Louisiana to kick things off, at least to the start of the day. Yeah, I'll give you just a few minutes to introduce yourself, tell us what you've done, where you're from, and what's in store for this market.
Yeah, what's in store for the market? I don't know about that one, but good morning, everyone. I'm Dan McNeil. Currently, I'm the trading manager for Zeno Grain. Zeno Grain operates the largest and most efficient export elevator in the Miss River. I've been down with Zeno for about 12 years, spent 10 of those years trading on the corn desk, and then the last 2 as the trading manager. Prior to that, where Brooks and I met was we spent a lot of time with CGB, who's an affiliate of Zeno Upcountry, and I spent time in mostly Illinois, Indiana, a little bit of time in Kentucky, doing different trading and management roles there. And yeah, happy to chat with you guys today and share whatever knowledge we can try to figure out.
Well, Dan, I really wanted to focus on corn and more specifically exports, and that's why you came in. For Zeno, you are really the face of kind of American corn market when you go overseas. You talked about your time here in the country. Tell us a little bit about your travels abroad and kind of how you represent American corn whenever you do that traveling.
Sure thing. I'll take a step back 2 years on that, just for when I was on the corn desk leading our corn sales efforts. And if you look at where the biggest places U.S. corn goes, especially from the Gulf, because we're kind of more Gulf centric, it's Mexico, Japan, Colombia are kind of typically the top 3. We had a little stint there where China was in the mix, and that has reversed course over the last few years as they have approved Brazilian corn and working on approving Argentine corn. So for a few years, the U.S. Gulf kind of it was the Gulf, it was U.S. or Ukraine. And so the U.S. had an edge on going to China. That has disappeared, and it seems like Chinese demand has waned as well. But I spent a lot of time developing customers in all of those regions because, we're trying to make sure we keep our house full as best as possible, and that means shipping corn year round, but especially in the time when beans aren't moving primarily to China.
Dan, I won't want to get too far ahead of ourselves here because we're going to talk about a lot of that stuff. But before we do, I kind of like to paint a picture of the situation that our customers find themselves in right now. And by our customers, I mean the American farmer. So on this call, we do have a few farmers. We've got agents. We've also got some folks from AgriSompo. But ultimately, it boils down to whether our customers are agents, whether our customers are farmers. What we do affects the American farmer, kind of all of us, and especially what you do. Really kind of wanted to paint a picture this morning of some long-term trends, also where things are at on the farm. This is one of my favorite charts. It's very telling, and what this chart does is it's an inflation-adjusted chart for a single bushel of corn. The blue line on here represents the actual price. So you may recognize some of these. Remember the good times in 2012 when we were up over $8.
Hey, Brooks.
Yeah.
Maybe everyone else can see what you're showing, but I can't. I just want to make sure that I'm there. If it's okay if I don't see it, but I'll maybe in the
Actually,
chat.
are you seeing what I'm seeing or showing?
Yeah, I can see it.
Okay. I'm not worried about seeing it as long as everyone else can.
Right. So essentially, you kind of see this blue line is the actual price, but the telling portion is the black line. And essentially, this is corn price adjusted by CPI or Consumer Price Index. And in some ways, that's how we measure inflation. And when we take a look at this, I mean, the challenging parts of this are check out how low we really are on these black dots. These black dots show you the buying power of a single bushel of corn. And you can see right now, it's worth it's about one of the smallest amounts that we ever saw. And so what it means for the American farmer is tougher times. Number one, you're going to have to produce more to show profit on the farm. And I thought I might outline a little bit of prices here, Dan, and I wish you could see this. This may be a little bit out of line, but I wanted to show average December corn futures price month by month going back to 2015. So a 10-year look. If you all got the daily market email, you've already seen this one. We threw it out last week. But as I did this research last week, I caught myself saying, I can't believe corn was this high, or I can't believe corn was that low this particular month. And I want you to take a look at this month by month. I believe the high number we got to was in May of 2022, 742, Dan, for December corn futures in May of 22. The low year came only 2 years before that, and it was $3.62 a bushel was the average for that was in actually 338 in August of 2020. Pretty amazing. I mean, that kind of range in that short a period of time. The average, and this is what really threw me for a loop, $4.44.5. Dan, December corn trading today at what, in the mid 420s?
Yes, sir.
So as bad as we think things are right now, we're actually right at the median point. And we're going to see that when we talk about carryouts and when we talk about our leftovers going into next year. We're going to see we're kind of right in the middle. And Dan, no pressure, but we've got you on here to tell us, we're in the middle, we're kind of on the fence. Which direction do we tilt on supplies? We'll talk about that here in just a moment when I pull up S&Ds. Before I do that, this may be some more worthless knowledge for you. Another part of DME was taking a look at our projected price and harvest price. And we did this on corn. Of course, this is going to be for your Midwestern states. It's going to be your February average and your October average. I also put on here total inputs. And total inputs, I got that data from University of Illinois on highly productive farmland. And while there's not a correlation between these projected prices and harvest prices and that inputs, anytime we see that separation, it means challenging times for the farm. And you can kind of see we just snuck by in 16 through 18. We were below on our projected harvest prices in 19. Pretty good years, 20, 21, 22, 23, not bad. 24, probably the biggest deficit that we've seen. And while I'm not trying to make a correlation there between the two, you can see the gaps and you can see the overlaps. And where you've got that gap between your bar chart and your line, things are challenging. How challenging are they? Took that same chart and really looked at the peak, this 4-year peak. And that's another subject for another day about these 4-year cycles. But you can see 2020 income on the farm. This is an acre in Illinois. I happen to know pretty well. In 2021 income, $1,442.25. And you can see the contributors. The big contributor was, of course, crop sales. And this is for 1 acre. Ad hoc and other. Now, you remember 2021, it was the year of the acronyms, right? PPP, CFAP, MFP, lots of money coming to us through the Corona food program that was out there. And a little bit of disaster program payment and some conservation thrown in. And Amber has got her hand raised. Let me see if I can get back to, I'm on a share screen. Let me stop for a second, Amber, and see if you can use the chat box to send us a question. Ashley, I'm going to have you keep an eye on that chat box. And Melissa says she can't see the screen either.
I'm not sure why. It looks like she clicked the screen by accident, but I've checked with a few others and it seems like everybody else can see it. So I'm not sure if it's a connection issue or what the deal is.
It may be if you've got multiple screens up too, that may have something.
Yeah, it may be hidden behind something else.
Yeah. I skipped from 21 to 23, and you can kind of start to see how things start to diminish here. Crop sales down 985.80 per acre. Crop insurance kicks in a little bit there. Conservation gets a little bit bigger, and a small ad hoc disaster payment. I'm not sure what that one was. I'd have to look back. 24, even leaner. Crop sales 900 to 1,000. I think they came in a little bit better than that. This projection was before harvest. Conservation at 30. And then all of a sudden 25 projection. Conservation becomes a big part of this. Crop sales and ad hoc pretty skinny at $10 an acre. I throw that out there and we kind of look at these expenses, and I'm kind of a nerd on these things if you can't tell. And I apologize for this being so small, but you can kind of see what the expenses have done as well. We are starting to see a little pressure come off on some. In other words, if you see this bar chart decline, you're seeing an easing of expenses. Expenses are getting a little bit cheaper. Let's take a look at some that aren't operating interest. This is a big deal. We've been in a world of 4 to 5% operating interest. Suddenly we find ourselves in an 8% operating interest world. That's a big deal. Fuel a little bit cheaper. Insurance a little bit cheaper. You guys all see that. Legal and accounting about the same. Machine hire about the same. Seed has come up just a little bit, estimated in 25 to be a little higher. Land continues to escalate. So that land cost continues to go up. Oh, it was just a pretty good comparison. And what I wanted to do before we really get into the meat and potatoes of our discussion today is paint this picture that things are pretty tough on the farm. We're going to hear about that more and more over the next couple of months. So Dan, I'm going to get a S&D chart up there because we painted a picture. We do live WASDE reports, and we're at a point right now when we look at corn, we're probably not going to change yields a whole lot from this point on. I think it suffices it to say we've got a record yield. We tick down a couple of tenths a bushel, tick up maybe. Acreage, pretty much know where we're at. So when we look at variables to our supply and demand, we got to think that the U.S. supply is pretty much known. We got that behind us. When we look at our big usage categories, we'll start with our big one, and that is our feed and our residual use. So what we put into our flocks and herds, we got estimated around 5.8 billion. You can kind of see that's a big number for us. Again, probably one that is predictable and is not going to change too much in the scheme of things. And then you've got ethanol, and I'll note that a couple of weeks ago, I think we had our highest ethanol production week in history. So things are going good there. You can see ethanol at 5.4 billion bushels. And if I need to slow down and break these out into millions and billions, let me know in the chat box. Actually, we'll keep an eye on that, and I'll go back and review that. I want everybody to understand this. And so you ask yourself, can we take more bushels into ethanol? Probably not. You know, we're not expanding that field of corn usage. That 5.4 looks like it's pretty steady. But then we look at exports. And while a lot of people are surprised that our feed and our ethanol usage is so big when exports look small, they look kind of small compared to those two. I've got them listed on here at 2.32 billion bushels. But of all the variables that are going to affect the bottom line or leftovers, Dan, it's probably going to be in that category right now, which is something you're directly involved with. The first question, just kind of a general outlook on exports between now and the end of the crop year. Are you seeing optimism? Are you seeing challenges? What's going on in that realm?
Yeah, good question, Brooks. And I can probably talk about this for a long time, so shut me off when I get too long-winded. I would tell you that generally our bias is, you know, the outlook looks good for exports this year. You know, if you look at our last, say, 10 years, we you know, even the number that the USDA is currently showing is actually on the higher side of that, higher side of average anyway. And you know, we're slightly above USDA, anticipate good opportunity. And I want to just kind of dig into that a bit. First off, you know, we're showing that with what looks to be much less Chinese imports this year than the last few years. China's corn crop was good this year, at least according to kind of, you know, the wires you see out in the open market, and their imports appear to be dropping. And they've been kind of the world's biggest user of one of the biggest users of corn from the world for the last 3 to 4 years. So them dropping has a significant impact on, world flows. But we're seeing sort of the rest of the world, demand pick up a bit. As you mentioned, ethanol margins have been good. Feed margins have improved because of the lower price of corn compared to the last few years. So all these people that have been slower or really hand to mouth are building up some stocks in the rest of the world. So that's kind of phase one, is even without China coming strong, we see good worldwide demand. If you dig into that, and why is that looking better for the U.S. than probably we would have projected 6 months ago? There's a few reasons. First is Ukraine, with the lower price the last few years. I guess for 2 years now, there's been a war in Ukraine. Since that time, their production has decreased, but their exports have remained fairly steady, and it's because they had pretty big carryout that first year, and they've just been slowly working through that carryout to the point now where they're, essentially down to minimal stocks of carryout, and we anticipate they'll continue to ship those. They don't have a lot of domestic usage for corn.
Dan,
But
let's stop right here real
yeah,
quick, because we spent a lot of time talking about Ukraine 2 years ago. We had some special reports on there, and you mentioned that the carryout was sizable. I want to kind of go back and kind of paint this picture, because I think this is going to play a big narrative over the next 60 to 90 days. We're going to put our focus back maybe on Ukraine and Russia for a bit. But if you remember, war starts in February, and prices escalate. Not a coincidence that prices were strong. If you look at that chart I just had up there, really good prices about that time.
right.
They didn't get much out of that country from February to August, and so the rest of the world kind of had to step in and take that share of Ukraine's exports. We saw a price rise. Ukraine was stuck with a fairly sizable carryout that first year of the war. Is that the picture you're painting here?
That's correct. I mean, effectively, they they had about a 10 million ton carryout that first year, and then and then the next year they kind of worked that down to 5 million tons, and this year it's looks to be down below 1 million tons. And if you look prior to that 10 million ton year, typically they just ran themselves out every year, somewhere between 500,000 and 1 million tons of carryout. So that year, as you said, they had about 2 to 3 months of very minimal. They started to figure out how to move some rail. They managed to get a few vessels out, moved a lot of truck into parts of Europe, but their logistics were very much constrained with the start of the war. Over time, they're figuring out how to kind of keep that moving. There have been multiple deals allowing agreements with Turkey, Russia, and Ukraine, allowing vessel freight to move through. Sometimes they break those deals, sometimes they don't, but it's generally happened. But what we've seen, Ukrainian production in that year of the war, when the war hit, it was around 42 million tons, and now this year, I think the trade is somewhere plus or minus 25 million tons. So their production has decreased through some acreage and some yield, and their exports have remained steady, and they've just kind of chewed through that carryout. So if we look forward, if the conflict continues and they don't find ways to increase production or acreage, Ukraine will be a lesser player than it has been the last few years, because they're just not going to have quite the crop. Who knows? That's hard to predict, but that's just what could happen. What that has done for us recently, it's a risky place to buy, especially to buy ocean-going vessels out of, right? There's a higher war risk premium for the vessels, all these things. And so for the last few years, when prices were very high, the Ukrainians would typically just discount however much they needed to discount to keep those flows moving, to allow people to take that risk premium, make a little extra money, and do it. At lower prices this year, they had been more hesitant to do that, generally speaking, and that's why we had seen some kind of non-typical demand from the U.S. out of the EU and North Africa, areas that we typically do occasionally, but not steady. But in recent, so if it was 4 weeks ago we were talking about this, I would say, man, this is happening full force, and it's exciting. Ukrainian values have dropped a bit now, and it's kind of more in equilibrium. So we're not seeing that demand like we were 2, 3, 4 weeks ago. But it's still, something to keep an eye on. Ukrainian values seem to be more on par. They're trying to market that more on par with world values versus huge discounts, maybe that we've seen in the last couple of years.
So, Dan, in Ukraine, just to kind of clarify this, that's going to put them, I mean, as far as versus our production, it's relatively small, right? Just under 1 billion bushels, but their largest usage is export.
Correct.
So where we feed flocks and herds, where we put corn into ethanol, the vast majority of their corn's hitting that open market. So just to kind of paint this picture, if Ukraine's down 150 million bushels, and we pick that up, that's a huge deal for our ending stocks, our carryouts to the next year.
Correct. Yeah.
So while we're talking about a relatively, I mean, they're big production worldwide, but relatively small to the U.S. Just these little changes, big impacts on that export variable that we talked about. Dan, I've got a chart pulled up right now of our export markets over the last, I guess it's 8 years, 2014 through 2023. We see Mexico at the top of that heap. Give us a just a quick synopsis on our number one customer for corn exports. Things good there? Any concerns with new administration?
Man, I'm not even going to talk politics. I think that, the gist of it when we talk about Mexico is rough averages about, say, plus or minus 60% to 2/3 flows into Mexico via rail or truck every year. It's going to be, and most of that is very difficult to compete with, from the water, right? So that those flows should continue. The second thing is, so that leaves, between 1/3, say 40%, to come in via water. What we've seen over the last few years is the Mexicans are also willing to buy Brazilian corn from the north of Brazil. So that competition is coming in from Brazil, which has reduced the U.S. a bit. But currently what we're seeing is there was a drought in Mexico last year that reduced their water table and, kind of has their production a bit on hold. And I don't know how anecdotal it is, but, that I think the demand for tequila is also strongly on the rise. And that's putting a lot more agave into production. And some of that is in corn areas, is my very limited understanding on that. But I think it's true. So all that's to say, we're seeing really strong exports again this year, and it feels like that should continue. There's been a lot of saber rattling about, and it's made a lot of news about them banning GMO corn for import. Recently, they've kind of said, no, that's just more for food, not feed. Clearly with I don't want to get into politics, but with the new administration, I'm sure there are going to be a lot of negotiations around a lot of, trade flow within U.S., Canada, Mexico. But we would anticipate Mexico to continue to be a really strong corn buyer. And it's been even, that flow has been stronger than normal, especially coming, via the Miss River in the last, 6 to 9 months.
Yeah. Well, I'm going to look at number 4 on our list because you've spent some time down there in your career, and that's Colombia as a buyer from the U.S. Colombia looks like, the amounts they buy are fairly steady. Seeing good things there.
So it's, it's interesting. The Colombia has been a really steady buyer, and part of that has been because of trade deals that it's fading out over time, and I can't do a great job of explaining it, but there has been a non-tariff quota that the U.S. has been able to export into Colombia without any tariffs versus other countries having some, and that has kind of led to some good base demand for us over time. That amount of shrinking over time, and it has to do a lot to do with price as well. So it's a complicated formula, but Colombia is a growing economy. It's a growing country, and they are a good trade partner. I have spent a lot of time down there trying, working on developing those flows, and it works well. Again, what's happened though in the last few years is so Colombia, they're kind of on both sides of the of Central America, right? They have a coast that is really close to the north coast of Brazil, and then they have a coast that from the U.S. you have to go through the Panama Canal, and that sailing time to Argentina is pretty close. And for years, man, my first 4 or 5 years as senior corn trader, they were buying almost 100% U.S. About 2-3 years ago, when China started buying U.S. corn and driving up U.S. basis values, comparatively, Brazil and Argentina got really cheap, and that started pushing Colombia, Peru, kind of back into Brazil and Argentina. So you know, uh, world demand and supply is always sort of quasi-static. So if when China started pulling more U.S., that pushed some of our other good customers
Yeah,
to look at other areas.
it's amazing how elastic that world works. Whenever one source is high, we find the other source pretty quick.
Right.
A steady customer for us in that number 2 role has been Japan.
Mm-hmm.
And I know you've spent some time in Japan as well, probably coordinate with them as much as any other country. Solid there still.
It's generally the same story, but this story started in 2012. Prior to 2012, Japan bought almost exclusively U.S. corn. You remember the drought of 2012. Was my first year on the desk at Zeno, and it was the smallest U.S. exports since I think when I was born back in the early 70s. That was because the crop was just so small, and domestic use needed it. So that year we saw, man, I won't get these numbers exactly right, but that year we saw U.S. corn go about, I think, $1.20, $1.50 premium over Brazilian corn, and that enticed our number one, our best customer, Japan, to try out Brazilian corn. And at that time, they were like, "Yeah, man, Brazil has to be a massive discount to take it." Fast forward to today, and when I visit Japanese users, I'm telling you, it's a coin flip. Half or more say they prefer Brazilian, and half or more, and probably half or less say they prefer U.S. So over a 12-year period, that mindset has changed that much once they started, and that's the problem we run into when we lose kind of when we give access to markets to competitors. If you're talking from a straight U.S. perspective.
I think, quality has, I spent some time down in Brazil in 2001, and, definitely the farm has changed a lot, how they handle grain, the quality of their grain. That weighs into Japan. And of course, $8.36 corn weighs in at that equation as well. And I'm kind of referring to that high mark that we hit back in August of 2012. So in the number 3 spot comes China. And what I'd like to do here, Dan, is transition this from how things look with China. I'd like you to kind of address the attitude of, or the question of them having an attitude they don't want to buy U.S. corn. I think that's a little bit of a fallacy. I think it has to do more with economics than anything else. And then I would like to transition this into, how does a tariff actually work? We hear a lot about it on the news. How would it affect the job you did? But first, how are things with China in regard to that number 3 spot on our export list?
So it's always an unknown, just because getting understanding the data out of China and understanding what they will do when it's tends to be more centrally controlled, right, is difficult. But our best guess this year is we don't expect very big exports out of the U.S. into China this year. And the reason is we don't think they're going to be needing to import as much. We think their carryout is larger, and there's also this underlying unknown today of, is there going to be another trade war? We've seen, we just don't know what's going to happen with that, and that unknown is going to prevent Chinese buyers from buying next spring, next summer corn today, because they just don't know.
Now, Dan, I want
Yeah.
to challenge you on that. But when you said it prevents China from buying that U.S. corn, clarify that a little bit for us, because I think there's a lot of misconceptions on exactly what a tariff is and how it's exercised. But have you ever seen a tariff on a bushel of U.S. corn going to China? I guess is the first question.
So my recollection in the last time that we had a trade war, uh, I do not believe there were any actual tariffs on ag products placed on ag products from China. A lot of that was they just stopped. I mean, I think effectively they just stopped buying because the U.S. was placing tariffs on a lot of their things.
Yeah.
But what we have seen out of China for a long time is there has been quotas, and essentially the quotas allowed Chinese privates to only buy, X number of tons of corn, uh, free of any, I guess, essentially tariffs or increases in price, and then
Penalties, yeah.
and then the government could also buy a certain amount of tonnage, and anything above that would have to be granted permission. In that kind of that whatever 2018 through 2022 range, we saw that kind of go by the wayside, and the government imports grew dramatically as they built reserves and things. Another example though would be, I was talking about Colombia. We were seeing sometimes artificial demand of U.S. corn because Colombia had placed tariffs on Argentina Brazilian corn, and so that made that Argentina Brazilian corn more expensive for the buyer in Colombia, and so they bought U.S. corn to avoid that, whatever percent tariff it was.
Yeah. So then I've thrown back up the supply and demand from 14 to the 24-25 projection out there. And while you may not be able to look at it, it's got an estimated 1.938 billion bushel carryout. I think right now we see our numbers strong on feed, our numbers strong on ethanol. I get this sense of positivity from some of the things you're saying. I know it's tough to make a call, but maybe that ticks down. Is it reasonable to think that maybe that 1.938, maybe that low water mark could be 1.8 and change? Is that possible?
It seems definitely possible. I mean, I believe that most in the trade would say the USDA the current USDA number in print seems to be a reasonable estimation, but it could go higher for sure if we see problems in Brazil or Argentina with their crop, which would be harvesting next spring, next summer. That could bump up demand, or if we see China come in. Those are kind of two unknowns.
As we look back at that number, and you guys can follow along in this blue shaded area down here, when you look at our high water mark of supply, our carryout was 16-17 crop year, Dan, just under 2.3 billion. Our low water mark just a couple years ago at 1.235 billion, and it stayed relatively low 2021 22. So we'll stop right there and we'll look at correlation to price real quick. Remember the 2022 23. I'm going to go back to that December average chart. And I guess my point is here, if you don't follow this day to day, it's I want to show you the direct correlation between a carryout and a better correlation of stocks to use, which I'll have Dan explain that here in just a second. But when you look at that 20, 21, 22, check that out. 501, 637, 559 for your averages on a monthly basis for the year. And when you come back and you look at that carryout, you can just about see that lag of 1 year on all of it. That year and crop year are going to be a lag, but you see this 1.235 billion to 1.36 billion bushel carryout. So Dan, that's our leftovers. That's what we've got heading into the next year. Tell us how we would turn that into a stocks to use ratio, what that means over time.
Yeah, basically, if you're looking at stocks to use, those years you're highlighting, we're down to 8 to 9%, and all we're looking at there is take ending stocks. If you look at 2020, 2021, the 2020 crop year, ending stocks were like 1235, I believe. That's our numbers. I think we match USDA, and total demand was 14.9 million, and so that's 1235 divided by 14.9 is 8% stocks to use. And what that effectively is telling, if you think about the cadence of harvest and where harvest goes all over the U.S., we have about 3 months of between when harvest starts in the South in Louisiana and Texas and when it ends in, Minnesota and the Dakotas, pretty much a solid 3 month span. Um, and so, and so, what happens is, if as harvest gets going, a lot of the South is already, effectively out of corn because the stocks are in the North, and so all the feeders that are down South, they need that harvested corn to last through. But I mean, effectively, that low of a stocks to use is about as tight of a carryout as the U.S. can get without, sending a signal to the market that we need to increase acreage. We need to get more corn in the system because, 1.2, an 8% stocks to use is really only about a month's worth of stocks, and harvest. When harvest is trailing over 3 months, there's a lot of discombobulation of where the supply is and where the demand is over that 2 to 3 month period
So
until we kind
let's
of regulate the
talk about
stocks out.
stocks to use ratio, Dan. I love it because it's timeless. And if you go
Right.
back to 1980 and you see production, at half of where we're at today, it still tells the story of what we've got left. Now, believe it or not, in the 80s, when things were tough, we had stocks to use ratios up there, I think, into the 30s and 40% for a few years. So 8%, the market's on edge. We got some opportunity there. At 12%, and if you've been to one of my meetings, you kind of know we got a full bucket to make it through the year. That means we've got 8% to start out our day. Okay. Give us our parameters here. When does the market feel non-threatened? What percentage is that? Is it 12, 12 and a half, 11? What's your call on that?
It's an interesting question, and because you're also always looking at, what's the world stocks to use ratio? What are we looking at? Brazil, Argentina, et cetera. But you are correct that the U.S. is the highest corollary to price, and so, from the U.S. perspective, it seems as though that 12% is where the market feels comfortable. The market says, man, we got to keep a little risk premium in this because if the crop's not good in Brazil or the crop's not good next year, we could get in a bind. But if the crop's really good, we're going to 14%, and then we don't need it. So it seems as though, around 12% stocks to use is that comfortably on edge is what I would call it.
Well, I like what you say they're comfortably on edge, and really that's kind of the world that we operate in. When we look
Correct.
at the last 20 years, you really kind of have to throw out your 11, 12, 13. You really got to throw out your 20 and look at what's there, and that's the world we live in. And the type of markets we typically see there, Dan, are not great ones to sell into every single day. If I could go back 2 years ago and think, man, if I could just have 2 months of that market, you could sell into it every day. And it was nearly profitable every day for the American farmer. Tell us what a market is like at 12%. It's not without opportunities, but typically, how's the market trade? And then I want to transition to basis after that. This is going to be more surrounding futures, but what's typical of a market at a 12% carryout?
Well, it's kind of the world we're living in right now. It's where we kind of finished last year and roughly where we're at this year. And you're right. It creates ample volatility in futures, in calendar spreads, and in basis. Um, but it typically isn't going to create, runaway markets, right? So it requires you to be sort of nimble on your feet, have goals, stick to those goals, either if you're a basis trader or trading flat price. And if you're going to get, if you're going to get greedy or on the short side or the long side, you probably need to have a plan on how are you covering that via, options or insurance or things that, I'm not in the farmer world anymore, things that you guys are working with farmers on. But there's plenty of volatility in basis and calendar spreads. We've seen that recently. Spread, generally speaking, calendar spreads have been firm because this is a kind of carry out that if the farmer doesn't actively sell as we go through the spring and summer, the spreads will have to firm to pull that grain out of the commercial and the farmer's hands.
Dan,
But
I'll
if the farmer sells,
stop you
go
real
ahead.
quick right there because there's a lot of underlying factors out there right now, interest rates being probably the biggest one. We saw those margins. We saw that gap between our harvest and projected price and that cost of production, right? We're seeing that gap to where we're in we've got a little bit of issue in a lot of parts of the country. Going to be some refinancing of land done. I think the grain moves. I think the grain moves relatively fast. Maybe not because the market says to move it, but the bank says to move it. Um, One of the things and the tools that we've got, and we're going to refine this a little bit by the end of the year because I think times have changed, but we've got the action indicators. I try to update those on Tuesdays and Thursdays as often as I can. We watch that relative strength index. And if you guys are followers of that, you saw that RSI triggered about a week ago. We had December futures up there into the 430s. Dan, I really like the use of things like RSI, stochastics, watch where the spec fund position is at in making those marketing decisions, because I think in a lot of cases, the American farmer has to move this corn in the next 90 days in a lot of cases. It's why we've seen spreads change so much. So on the future side, we haven't given any specific advice, but I think the advice is watch for the short-term opportunities, okay? And know that we're probably going to have to market this corn in 90 days. We're going to have to look for those opportunities in 90 days. Now, the other component of farmer price is basis. And probably, Dan, we've got you on here and we focus so much on futures and the big thing. You are kind of the heartbeat. You've got your fingers on the pulse of basis. And there may be people on here from North Dakota and they say, hey, what's a guy in Louisiana trading CIF, looking at the CIF market? What does that have to do with my basis levels? And the answer is a lot. Okay. I want you to think about it. I've always referred to this as the domino effect. The river pushes the ethanol plant, pushes the rail, or maybe vice versa in that. Farmers seem to be a little stingy with moving this corn at these prices over the last 3 months. Are you seeing that in the Gulf at all when it comes to the prices that you're willing to pay down there?
Yeah, I tell you, there's kind of two parts to the prices we pay. We buy corn CIF NOLA, right? So that's like cost, insurance, and freight delivered to New Orleans on barges, and so one of the biggest components of our pricing for how we buy CIF and then turn around and sell FOB to our customers or sell to customers overseas is barge freight. And man, for the last 3 years now, we have seen record low water levels on the Mississippi River, lower Miss, and the Ohio and the upper Miss during harvest, and that has caused 3 years ago it caused insane logistic problems. Last year the market kind of figured it out, and the Corps of Engineers got ahead of it a little bit with some dredging and made it better, but still difficult. But it made barge freight climb dramatically, and the same thing has happened this year. So it feels like we've had 50-year low water events 3 years in a row now. But what that means is it causes barge freight to be a bit abnormally high because barge lines must move fewer tows in a unit that's moving up and down the river, which is less efficient. They're also loading less tonnage on each barge. Instead of 12-foot barges on the lower Miss, they're loading 10-foot or 9/6 barges. So you're reducing that amount in each barge by, call it 25%. All that leads to higher barge freight, which dramatically increases the cost that we would have to pay for CIF to entice shippers and farmers to move it. So that's in a harvest time window, this low water is a massive problem for U.S. competitiveness. We saw exports get really hammered last year during that time because U.S. price competitiveness was difficult, and there was plenty of corn and beans available in Brazil. This year, even though we had a bit higher, we did have high barge freight. It didn't go as high as last year, but we also seen the Brazilian farmer a little more stingy with his crop. So even though prices kind of climbed here during harvest because of high barge freight, we still saw the U.S. being, generally speaking, the best game in town for corn and soy. So that what the other farmers in other origins, how stingy they're being with their crop can greatly affect how hard buyers come to the U.S. and how hard we need to pull.
It's kind of a new facet probably for your job, isn't it, Dan? I can't imagine all the things you've got to balance here when we talk about the uncertainty in Ukraine, the fact that maybe selling cadences have changed down there in Brazil, the threat of trade wars. There's a lot of balls in the air to juggle. So I'll put you on the spot, and I promise we'll wrap up here in the next few minutes. But as we look ahead 30 to 90 days, let's say 90 days ahead, what do you expect as far as basis strength out of the Gulf? And again, I think this is a domino effect. Um, Assuming a fair amount of farmer movement, I think you're going to see a lot of farmer movement this Jan. Any prognostication there?
Yeah, I was going to say what you said earlier about farmer movement is probably the magic answer to that question. We are seeing good demand. We've seen demand for JFM April, May for what I would call non-typical destinations, for the Gulf. Again, I'm talking more Gulf centric, into the EU, into the MENA area, even a bit into some Asian destinations that we typically don't flow to. So that is good, and that means that demand looks to be strong. We just, we look really competitive compared to Ukraine, Argentina, and Brazil out in those deferred months. So it's going to require, good movement. So if the farmer, does not like current prices and moves slowly, we will push values towards delivery equivalent, and spreads will start, firming to pull that grain. If the farmer moves heavily, then basis, we will see times of basis dropping and then times of it firming as we kind of work through those logistics. So, as we look at it today, we didn't feel as convinced as maybe you are that farmer movement is going to be strong, but that will hold the key to what basis does.
I think that it's largely an unknown until about this time of the year. And something happens this time of the year across the U.S. where farmers start to go to their accountants.
Right.
And I know that our audience out there all knows the story too well. You're probably running some reports for your farmers as they go to the accountants. And they're probably not getting the best news out there. They're also seeing how much operating interest they've accrued. And in some cases, it's, this operating interest where in years past had been budgeted in $16, $17 an acre. Now, you're looking at, $35 to $40 an acre. It's a sizable expense across the farm. And I think it's going to cause farmers to have to take bushels to town. Whether they choose to take corn or beans, I don't know. I think there'll be a fair amount of corn move. And I'm afraid that basis levels could come down as, your more progressive farmers kind of book theirs in advance, things like that. But I also think that, you painted a picture where farmer grain can go to town and we can actually see a rally in the futures market at some point in time that is missed out on. Now, I'm going to have you go back 20 years and put your farmer marketing cap on here. And you mentioned it earlier, the use of options. And I'm sure you guys use the options in what you do on a day-to-day basis. Give us a rundown of a farmer has to take grain to town. Hopefully they get this strong basis level. They lock in futures. How would they use an option to protect themselves, and how far out would you go?
That is so much more your world than mine. But man, when I have a few farmers that I still talk to, I can't say I give them advice, but my advice, I can't say I give them good advice, but I always advise them to understand where is a profit, and if you can lock in a profit, you should do that. And if you want to have upside, look at either buying outright call options or like buy a call spread. If you look at the prices of maybe May or July type options, times that we're still more U.S. focused on the crop, and maybe if you go out to July, if you like to worry about the weather premium out there. But if you don't, those are going to be expensive, right? Because it's a volatile underlying asset and it's a lot of time involved. So, maybe you want to gain 50 cents in upside if it's out there. Go try to find a spread and options, one more near the money, one more out of the money, and spend 10 or 15 cents to make 50 or 60 if you can figure that out. And with working with your local grain merchandiser or your farm marketer, and I feel like that's money well spent. That way you're locking in a profit, you've got upside, you can sleep at night, and move on. You're going to you're going to grow a crop next year as well.
You may be preaching to the choir here because we've got a lot of risk managers on the call today, so they understand that. They have to kind of explain that when they take different policy combinations out at sales season here really quick. That another conversation that you want to have. Also know when your farmer typically sells. If you've got a farmer that empties out the bins by the end of February, maybe it's a March option they look at. You're going to cheapen it up, not cover as much time. But if their marketing year was generally over at that time of the year historically, maybe they're okay with that. If there's somebody that can hold those bushels longer, keep in mind right now, at 8%, your cost is a little over 4 cents a bushel just in interest per month to hold corn. And so I think that's going to weigh into a lot of decisions too. You look at these carries that Dan talked about and spreads, and they're big, but whenever you throw operating interest against those, they look kind of paltry. They look pretty normal. So, well, we've got a few minutes. I'm going to wrap this thing up. If anybody's got any questions, now is your chance to shoot those in the chat box. Dan, I can't tell you how much I thank you for your time today. It's nice to have an expert on here. We talk a lot about exports in our marketing calls month to month, but it's really nice to have somebody on here that it's in front of you every day. And I think you've given us some pretty good insights into how it works. So I
appreciate my pleasure.
Well, it doesn't look like I've got any questions. A lot of times I'll get some via text later on. Dan, if I get something, I'll shoot it your way. I appreciate everybody joining us for the November marketing meeting. I almost say December every time because we're so late in the month. It just happened to fall this late. But we'll be back with you for the live WASDE in December and another marketing meeting pre-Christmas. So I appreciate everybody's time. Have a great rest of the week.
Take care.